Welcome, and thank you for listening in on our latest Economic Outlook report, focusing on continuing to open up the U.S. economy amid the growing cases of COVID-19, a topic we are all eager to gain a better understanding of. Joining us today in today's conversation is Prevedere's Chief Economist Andrew Duguay. Andrew, we're looking forward to your insights.
Thank you, Nicole, and it's good to be back. Last time we talked a couple of weeks ago, we were talking about how cases had just reached the fourth highest on record in the United States, and since then we don't really have better news. The caseload of new coronavirus cases each day seems to increase, and so I think originally people were thinking that there'd be a big, huge wave, then we would flatten the curve, and then there was the threat of a second wave happening in the fall when the normal flu season kicks in, or that when people start to get back to normal. I think what we've seen is just an immediate second wave as businesses across the United States have opened up, perhaps prematurely. And we're going to talk a little bit about that, the economic implications, as well as what is some data to watch for, and also some lessons learned, right? Here we are in July, we're looking forward to the second half of the year and what will unfold, as well as thinking about 2021, but what are some lessons that we can learn from our analysis throughout the first half of the year with all this disruption that's happened due to COVID-19. So per usual, let's start by looking at the actual number of cases. And so here I have highlighted just the most recent data right up through today, July 8th, we hit a record high. And so many cases, this is obviously spreading throughout many states. Certainly some areas of the US are seeing a number of new cases not increase, but that's being increasingly few areas, right? So we're kind of all in this together, and this is going to start to change policy. So while we were talking about how is reopening going to impact the economy in a positive way, now we're talking about what is actually halting that reopening. And as we speak today, there's about 9 states that have already reversed their reopening plans in some fashion, either having bars and restaurants fully close again or reducing them back to a limited capacity after they increased the capacity. And so we're going to start to see the economic ramifications of this in multiple ways. I think psychologically there's an X factor that also gets included in this, and the fact that if you were thinking about summer travel plans and getting things back to some sort of normal level, I think that sort of shelter-in-place mentality is still going to reign supreme. So we know that the economic ramifications are quite complicated due to stimulus and many people being able to work from home, and different federal and fiscal policies that are going to be enacted because of this increased caseload. But the very fact that we are seeing increased cases means that we are going to have to limit and restrict our movement in some way in order to curb this again, and that grand goal of having things reopen and get back to normal is seeming very distant at the moment. So again, more volatility, right? This is part of the uncertainty in every economic outlook is, can we control the number of cases? Unfortunately, that nice curve that we've seen in places like Europe and even just our neighbors to the north in Canada has not necessarily shown itself in the US. We're looking a lot more like Brazil, which is really struggling with COVID-19 right now. So this is just another look at the number of cases, but this one's actually put in perspective of per capita cases, right? Per 1 million residents, and you can see that the United States is at a very elevated level of new coronavirus cases each week per 1 million residents, only to be outpaced by Brazil, which is really struggling. But if you look at places like Europe, and then if you through Asia, you'd see a similar curve here, right, where there was a nice slope downwards afterwards without a large second wave. We're in a unique spot, and I think it's interesting because you could probably relate this somewhat to different timings of actions and reactions by people and their attitudes towards social distancing. So no matter how you look at it, I think it's not a good situation for the US economy. What this means for the summer is that with all this disruption means that there's still a lot of opportunity for new changes, perhaps additional stimulus or extended benefits that are likely to happen in the summer. And so we're going to have to continue to watch for those to see whether we've talked about the summer of shock. I think that is very much a reality, is that we could face a lot of shocks if we do not see the government step in and try to prop up the economy like they have in the past months. So that could help things this summer, or if we don't see similar policy reactions to what we've seen the last few months, we could be seeing, I think, a real fallout from this in many industries that might not have felt the full fallout so far. So the downside risk is still great, it's still elevated, and we have to continue to keep our eye on this, because this is the first thing we have to do to solve before we can get back to full economic recovery and get to that U-shaped recovery that most economists are talking about. And so instead, what this could be very well looking like is some sort of W shape, where we kind of go up, we go down in a seesaw fashion. And so we have been talking about this idea of micro recessions, right? The fact that an industry could see an immediate downturn followed by recovery, followed by another downturn. This could be stimulus related, or even just the uncertainty that consumers themselves have over their future expectations. You might one week read the news and look at the stock market and feel very comfortable about spending money. And then the next week, the numbers of cases go up, new policy and restrictions are put in place, and there's more threats, and you could change your habits. And so what we're seeing across many industries is that the economic indicators, and I think we'll talk about this more next week and talk about a few different industries, but the economic indicators are not consistent, right? Across industry, across types of indicators, we're seeing some very strong positive reactions, including an earlier purchasing managers index for the services sector number that came out earlier this week for the US that was quite positive, very high, above 50, which means a return to growth. And that kind of V-shaped look, if you look at that one indicator, looks very similar to some other indicators that came out of China and stuff. However, there's other indicators which give you a more sobering look, and combined, this is shaking up a lot of industries, and that's why, when we've talked about this in the past, forecast uncertainty has increased, and we're going to see more misses in the future because it's just the nature of this, very uncertain. So what is a good grounding indicator? The last time we talked about some indicators that, no matter how you looked at them, could be giving you some false signals, and depending on how you interpret that. Well, here's an indicator that I think our economist team is looking at with a lot of frequency and really putting in perspective. This weekly economic index, it's put out by the New York Federal Reserve, and it's a rather new data set. It has they built a whole back history to it so we can compare it to last recessions, but it's really a proxy for the GDP growth rate, but it's only using high frequency data. And so here's a list of some of the factors that go into it that they build. So it's a composite, but it actually indexes very well to GDP. So picture gross domestic product, which comes out on a quarterly basis. Imagine if that data set came out on a weekly basis. That's what this is supposed to try to replicate, which is very important in these times, that you get more real-time insights, because quite frankly, who cares what happened last quarter, right? When the world's changing so fast. So if we pay attention to things like weekly unemployment claims, weekly measures of estimates of retail sales, electricity consumption, steel production, anything that we can get our data, hard data on, that's at a weekly level, and index those, this is what the US economy looks like. And to give you some perspective, when you see that dip that happened in April, where GDP, or this weekly economic index, bottomed out at around -11, -12%, the last recession in 2008, 2009, it really bottomed out at around -4%. So you see the recovery that we're having now, where we're creeping up from that level, is still very mild, and we still have a long way to go. We have a long way to go before we're even at a position where we could have a comparable to the Great Recession of 2008, 2009. And it's not linear, right? What we've seen is in recent weeks, we might be tying the fact that there's increased cases and more restrictions being put in place to weaker economic activity. You saw that minus 6.8 change to minus 7.4. This to me is, very concerning, or at least a more sober look than some of those other indicators that are coming out, which might be signaling some opportunity in the recovery. And as leading signals, that might be the case that we are going to see some recovery. However, on the grand scale, when you start looking at these particular data sets and the fact that they're tied to hard data, right, actual steel production, actual layoffs, we still have a long ways to go in the U.S. economy. So we're in a very fragile spot, and the number of new cases are rising. So as we head into the summer, there's still a lot of uncertainty. Even if we're all looking forward to things getting back to normal, we do have a long ways to go. That's going to have some business ramifications. So this, I would say, is my data set of the week. This is the weekly economic index. You can find this on the New York Federal Reserve's website, as well as at Prevedere. Please check it out. It's a good, I would say, high frequency indicator to follow. And as you know, we have been spending a lot more time talking about what are some good high frequency data points. And that is actually one of our lessons that I would say we have learned from the first half of the year. So as we reflect on all the events that happened in the first half of 2020, of course, there have been a ton. And we want to say, what can we take away from all of that turmoil and that has happened when you think about economics and indicators and how the markets impact your business? What can we take away from that to learn and apply to the second half of the year? So we've covered a lot of topics on these weekly webinars. I wanted to talk about, I think, the 3 key takeaways for demand planning for the second half of the year. The first one is one that we have spent a couple webinars talking about, but it's the fact that because data is so uncertain right now and attitudes are really diverging from normal economic data sets, a good analysis of the marketplace needs to blend soft data with hard data. Now, for those who don't know, and as a refresher, when I talk about soft data, we talk about things like opinions, attitudes, and expectations. Those matter a lot in a time of crisis and a time of immediate crisis, because so much about the recovery is going to be perceptions about the recovery. Do I feel safe to spend again? Am I going to plan on a vacation? A lot of that has to do with a perception about what the future is going to look like, and your confidence in having a job, income, safety, all matter. And you capture a lot of that with soft data. So think about Google Trends, right? Google searches, right? People are intending on, they're signaling their intention by their search terms. It's not necessarily that they're doing something, except that they're thinking of doing something, and that's called soft data. And we found a lot of value at Prevedere with our customers looking at consumer sentiment metrics and consumer expectation metrics, because everything has changed with COVID-19. So some consumers are more bullish, others are pulling way back. Obviously, the way they're spending and thinking about spending, whether that's more at home or more, cooking from home or backyard projects, and also spending less on travel and other forms of leisure, soft data is really going to get some of that intent. Versus hard data, which is normally what you want to spend a lot of time relying on, because those are the real facts. How much income do people have? How many jobs are there, right? Those are the core principles of what drives an economy. And those are still very important, but in this time of, I would say, psychological crisis, right, with a real pandemic going on, you need to blend people's attitudes about the economy alongside their real economic situation to get a full picture. Second thing is the one I was just talking about, the value of real-time indicators. It's no longer good enough to just rely on one or two indicators that come out on a quarterly or monthly basis. Really search and hone in on what drives your business that you can benchmark against that comes out on a routine frequency. So I gave you one example of this weekly economic index that the New York Fed comes out, which is a weekly estimate of GDP, which is a quarterly indicator. If you're a business that follows GDP, well, you should probably be paying attention to the weekly economic index, as well as several other data sets to get a holistic picture. Obviously, with times changing so fast, the value of real-time data or higher frequency data becomes much more valuable, because data sets that are getting released with a data lag of a month or two are just going to be showing you what happened yesterday, and we know that that's not necessarily indicative of what's going to happen tomorrow during these times. So in the second half of the year, if you're not doing this already, really hone in on what are those key indicators that are of more high frequency real time that you can be following alongside your business. And then I think the third takeaway that we were seeing with our customers, and very important during these times, is don't linearly extrapolate that recovery. Because when things started to get bad, people were planning for the worst, and which is an okay thing to do. But if you linearly extrapolate that trend that started in March and April, kept going down, you could have missed some of the high side or some of the mini recovery that happened in May and June. And I think likewise, as we're sitting here today in early July, we've had record stimulus, and a lot of people are expecting that things are going to get back to normal, and they might be over expecting the fact that the recovery to date has felt pretty strong and felt pretty much like a V-shaped recovery, that we're not going to hit some bumps in the road. I think we're going to face a lot of challenges this summer, especially once we move into August and September, especially if we do let some of those provisions expire, like the extended unemployment benefits from the federal government, which expire at the end of July. Those are going to be some real roadblocks for the US economy, especially at the rate we're going with the number of cases. If those do get extended, we are still looking at a situation where you have millions of people who are dependent on unemployment for an extended period of time. That's going to hurt, the productivity of just the overall economy, and more businesses that might be hoping to survive a month or two. If you extend that to 3, 4, 5 months, then you get a real situation where the job losses start to outweigh the job gains again. Right now, we're seeing some recovery as businesses are hiring back some of those who are temporarily laid off, and that's where a lot of the positive news about jobs is coming from. But it still has a long ways to go. Still millions of jobs need to be created in order to gain back those that are lost. And so I think the long short of it is that we do see a lot of oscillation that's going to happen in the future with the economic indicators, with businesses. And so it's going to be, I think, very important to not just linearly extrapolate, but to consider the ebbs and flows of different indicators that matter to you as we go through these summer months. So if things are looking good for you, take some caution. I think if things are looking really bad, try to find where those signals are that things are going to turn around, because I do expect a lot of volatility in the future. And what we're really seeing, I think, essentially is that we're seeing a lot of micro recessions and micro recoveries, and so it's not going to be a smooth movement through the summer for the U.S. economy. I think we're going to see a lot of different and fast-changing environment for a lot of businesses. So when we talk about planning at Prevedere, we've been helping our customers thinking about planning in terms of scenarios, right? It's not good enough to do a point forecast anymore. You need to think about your high side and your low side scenario, come up with a baseline scenario, which should be driven by a lot of real-time indicators with a blend of soft and hard data. So see how I tied those three things together with the lessons learned. But that's really the approach that you have to take, is to say, fully admit that you don't know what's going to happen in the future. There's so much uncertainty tied to the health pandemic. But if you're thinking about it the right way and thinking about it by looking at the right data sets and giving yourself a range of outcomes and focusing on the most likely and making sure that you can adapt quickly when those times change, that's really your best chance of executing successfully on a plan in the second half of the year. So those are my 3 quick takeaways lessons we have learned at Prevedere working with our customers in the first half of the year that we think will definitely apply to the second half of the year.
Thank you, Andrew. Sobering and insightful presentation. Not only looking at a U recovery, but the potential W recovery with those micro recessions depending on the industry, some real food for thought. It's clear that we're all excited to reopen our economy, but we need to equally be concerned with the potential health and economic ramifications as those cases continue to rise. So that concludes, this economic update. If you have any questions for Andrew, please feel free to contact us at the contact information on the screen. Stay tuned for follow-up presentations. Thank you.